Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make any investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's videos, and all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the four things we learned in the markets this week, starting with point number one. Point number one is the market had its worst week since earlier in the year when Silicon Valley Bank, SVB, failed, kicking off somewhat of a mini banking crisis for the month of March. If you remember back then, it was about as worse as it's been this year. Much of this week's negative sentiment was centered around the downgrade of the U.S. credit rating by Fitch. And I'm going to hit on that more in point number two. Before we look at the numbers for this week, let's briefly discuss two stocks that reported earnings this week. And they're pretty darn important to the markets. And those, of course, were, if you're paying attention, Apple and Amazon. If you weren't paying attention, that's okay. That's why we have this video series. Many of our mutual funds and ETFs hold these two stocks, and many of them hold them in very big positions. So they're important to you, us, and everyone. Amazon delivered strong results, which saw its shares tick up by 8%, which added around $100 billion to its value. According to the Wall Street Journal, that's the equivalent to the entire size of Kroger, which is the largest publicly traded grocery chain in the U.S. And don't be surprised, it's not the retail business at Amazon that's dominating, but rather it's AWS, which is its cloud computing business. Strong results there helped Amazon double its operating income from a year earlier to $7.7 billion. Now, Apple also reported, and they had less than stellar results, albeit many were expecting that already. They reported 4 straight quarters of revenue declines, which hasn't happened for that company since 2001. And partly to blame were iPhone sales that came in weaker than expected. Now, our weekly look at initial claims for unemployment insurance as a leading indicator for any breakdown in the labor markets, this week, those came in at 227,000 compared to 221,000 last week. And finally, before we get to market results, I'm going to start showing you every week the Atlanta Fed's GDP Now model. If we slip into a recession, we should being the key word, see it here first because it'll eventually present itself in the actual GDP number. Now remember, this model takes real-time economic data and estimates the GDP number for next quarter with a high degree of certainty. The number will certainly change week to week. That's why we should look at it week to week, but it's changing in relation to real economic data. Now this week's number comes in at 3.9%, slightly higher than last week and way above those stubborn Wall Street economists, although they have been raising their targets as well, as you can see from the screen. For this week, the S&P 500, which is our proxy for growth and growth in income, but only when taken together, that was down 2.27% for the week. The Russell 2000, which tracks our smaller and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was down 1.15%. And finally, the MSCI EAFE, which tracks international stocks across the global developed markets, that was down 3.06% for the week. That was the loser for the week. Point number two. This last week, we saw the U.S. government get a credit downgrade from rating agency Fitch. That was the big news for the week. They lowered the U.S. credit rating from AAA to AA+, which is still investment grade. So it's not like they're junk bonds or anything like that. And in the comments of this video, I'm going to post an article I wrote on Friday night with our partner Clearnomics. And this article discusses our thoughts on the matter of credit downgrades and if you should make any investment decisions because of it. Let's first summarize the article through this point, though. Partly, I correct a myth in that article, and that myth is that the Chinese government owns most of the U.S. debt, therefore making us some kind of borrower slave to the lender to China. Well, Proverbs 22:7 is correct. The borrower is slave to the lender. But the lender in this case is not China. It's 75% American families, corporations, and pension systems owning U.S. debt. China isn't even the largest company on our debt, and that's Japan. And they're an ally to us in the Asia-Pacific region, owning about 3.5% of our debt. If something goes down with Taiwan, Japan's our friend. China's not. Well, China only owns 2.8% of the U.S. debt, and Europe owns 2.1%. Now, while markets did take a breather this week, it seems that the credit downgrade just gave the markets a reason to pause rather than an indication that Fitch did radically change the economic landscape. As mentioned in the article, you as an investor have to determine what you should worry about and what you shouldn't worry about when it comes to investing. Hint, things you should worry about: your risk tolerance, meaning how aggressive or conservative you can stand to be in investing. Another is your time horizon. You should worry about that, meaning the longer your time horizon, the more you can afford to take risk, albeit intelligent risk, within a portfolio. The national debt and a credit downgrade has been a source of worry for decades now, and thus it's something that just you can't write an investment thesis around. Otherwise, you'd miss an entire decade of investing. Basically, since the Bush era, we've been worried about it. How about this thesis? Dave Ramsey says invest 25% of your funds outside of the U.S. because if the U.S. does have a problem because of runaway debt, you'd be wise to not have all your eggs in one country. Spread your eggs out overseas a little bit. For now, let's hope this is a wake-up call to our government that runaway spending should be controlled. Both parties, by the way, Democrats and Republicans. The latest possibility now exists if calls from the Democratic side of the table are answered, which is to call this heat wave running across the country as part of a climate emergency to put the country in a state of emergency. This would give the U.S. government wartime powers that they had during COVID. And let's remember what happened then. Control that exceeded the authority they've ever been given, and trillions upon trillions of dollars spent in the most unnecessary of causes, not COVID things, but there was a lot of unnecessary spending. We increased the money supply by 40%, and guess what we had? Runaway inflation. Let's hope President Biden can maintain a level of common sense and put an end to these calls before it causes further credit downgrades in the country. Point number 3. On Friday, we received the non-farms payroll number for July of 2023 from the federal government. Now, this estimate was that there were going to be 200,000 jobs to be created in the month of July, and they only came in at 187,000. Pretty darn close. The healthcare section of the economy was the strongest of job gainers, adding about 63,000 new jobs for the month. Financial jobs added about 19,000, and leisure and hospitality, which has been the leading sector for most of the recovery from COVID, added about 17,000 jobs. This number, while slowing from previous highs, as you can see on your screen, shows the U.S. job market is still very, very solid. There is no recession indicator in these numbers. In addition, the unemployment rate ticked down a hair to 3.5%, whereas economists had predicted it would have held steady at 3.6%, where it ended last month. This is just slightly above the lowest unemployment rate we've seen since 1969. So nice job to the labor market this week, Friday, staying strong, being the bedrock of a good economy. And point number 4, let me give you the argument for why one wouldn't worry about the government debt right now. Something I didn't put in the article because I wanted to specifically save it for this video series. Now, with our population growth in the U.S., do you want to guess what it is? It's on your screen right now. It's below 1% for the last 5 years. America's ability to meet her debt obligations is going to be more dependent on worker output and productivity gains as opposed to population growth. How do you grow your economy when you're not adding more workers to produce? Well, the way you do that is you have to become more productive. You have to make people you have in the economy more productive. Productivity is going to be the main driver of earnings growth in stocks and publicly traded companies and tax revenues for the U.S. government. As you can see on your screen, the last 10 years has been bad. Most quarters coming in below the long-term average of 2.16%. This is truly the number to watch into the future if we don't go all Dave Ramsey on our government debt and pay it off. The only way to sustain higher debt payments is to have a bigger shovel, a bigger income. And that shovel, being the economy, needs to keep growing or becoming more productive. As mentioned earlier, growth does not seem to be happening. And with a constant downgrade culturally on the nuclear family, I'm not optimistic about population growth becoming all of a sudden back to where it used to be. However, I am bullish on the U.S. economy because we have proven through many decades that we can innovate over time, leading to productivity gains needed to provide economic expansion, thus covering the federal debt. By the way, want to know the best country for birth rates leading to population improvement? South Africa. And number 2, India. Possibly 2 countries that may provide meaningful economic growth because demographics equal destiny when it comes to the economy. That actually rhymed a little bit. Maybe I'll make a financial advisor song. Demographics equal destiny when it comes to the economy. We'll see. If you enjoyed the 4 things we learned in the markets this week, would you do us a favor? Hit the like button in YouTube. Hitting the like button helps us with YouTube's algorithms, getting our content out to more people, as well as hitting the subscribe button. And that'll help whenever we push out content for you to be one of the first to see it on your YouTube feed. As well as you can do the same thing on Rumble, where all our videos are simulcast as well. If you would like to meet with any of our financial coaches or financial planners, you can go to the link in the comments below. The link in the comments will help you to schedule a meeting with any of those folks. The financial coaches will help you in baby steps 1, 2, and 3. Get out of debt, stay out of debt, live debt-free, be that accountability partner, or help you with any college planning, not saving how much for college, but saving on the cost of college they can help you with. And then if you'd like to schedule a meeting with our financial planners, you can do that right there as well. And they help you in baby steps 4, 5, and 6, where you're saving for retirement, saving for college, if that's applicable, and paying off that house so that you can get your last debt out of your life forever and live and give like no one else in baby step 7. That's the place to be, my friends. And we're trying to push you there 1 week at a time. Thanks so much. We'll see you next week.